Are you concerned that we might be in a recession right now and that there could be a housing crash right around the corner? And if so, are you thinking that you should sell all of your properties before they lose value? If you were thinking about buying, maybe waiting until values come down? I'm Kathy Fettke, and welcome to On the Market's YouTube channel, presented by Fundrise. I don't blame anyone for being a little paranoid right now. These are really strange times, and nobody wants to go through another 2008, where property values in some places went down 75% and took 10 years for those values to come up. We know people were underwater and it was a very difficult time. So nobody wants to go through that again. So when I have a lot of fear, and there's a lot of fear in the air, I come back to three principles that I learned years ago, actually from Robert Kiyosaki. Focus on job growth, population growth, and affordability. And when those three things are in place in a housing market, it tends to work out. Of course, you've still got to buy the right property in the right neighborhood and, all those things. But from a metro perspective, those three things need to be in place: job growth, population growth, and affordability. So let's look at job growth today in the US. We just had another record month, unbelievable amounts of job growth. In fact, in 2022, there's been an average of 450,000 new jobs every month. And to put that in perspective, in the decade before COVID, which was a pretty robust economy, if you recall, going up for almost that whole decade since the Great Recession, job growth was around 195,000 per month on average. 195,000 then, 450,000 now. So we have a robust job market. Of course, not in every metro. You've got to really hone in on the metros where there is that kind of job growth. And I would think that you'd be pretty safe there in owning real estate, because when there's that much job growth, you get the second thing, population growth, because people follow jobs. And what we're seeing right now is, of course, you've heard me say this before on other On the Market episodes, we have the largest generation ever in history at first-time home buying age. The millennials are a huge generation, 82 million, and the largest segment of them are ages 28 to 34. And 32, 33 is average first-time homebuyer age. So you have this massive wave of young people wanting a place to live. Population growth is there. Add to it that these people are highly educated, the most educated ever, college graduates, and they are tech savvy in general, which means many of them can really work anywhere. And so that's driving growth in some of these markets that hadn't seen growth like that before. Follow the population growth. Where are people going? Where are the migration patterns? I often follow things like U-Haul and Atlas van lines. They come out with reports every January showing where people are moving. And of course, we're seeing a lot of people moving from the high-priced markets to more affordable markets, moving out of places like San Francisco, LA, and New York, and moving to places like Florida and Texas and Arizona. So we already knew that this was happening. It was in play before COVID. COVID really sped things up. But again, follow the population growth. Now we are starting to see a decline in population growth, but that does not mean our population is declining. So those headlines can be confusing. Actually, our population is growing rapidly in the US. When you look at the chart, just look it up, it's growing rapidly. But the rate of growth is slowing down, which may be a good thing. We don't want to overpopulate. Follow where these people are going, and if you've got jobs and people, housing's probably going to be healthy in those areas. And then you can add that third thing, affordability. Okay, this one is a bit out of whack, right? This one is tough. With home prices having gone up on average 20% last year, and in some areas 40%, even higher than that in certain really super hot markets, well, affordability is not there, especially now that interest rates have gone up so much. In fact, it costs about twice as much in the payment to own a house today than it did just last year. Tough for home buyers. That means that many of those home buyers will end up being renters, which of course is good for landlords. But be fair, landlords, because these millennials need a place to live, and so don't jack up the rent too much. Make it fair, make it fair. All right, so we've got job growth, we've got population growth, affordability that is definitely out of whack. But like I said, so many people are moving out of these extremely high-priced markets and moving to more affordable markets. And so for them, it's actually not that unaffordable in these affordable markets. So that's why we continue to see prices rising in certain markets that are just ridiculously cheap for certain people, say coming from New York and moving to Tampa. Sure, Tampa absolutely boomed. We're still able to buy properties there for around $200,000. Try to find that in New York, right? It doesn't exist. Or in California. So it's all relative. But with this demographic shift and job shift, we're seeing a lot of employers moving to these more affordable areas too. Look at what's happening in Texas. The growth won't stop. Same with Florida. Many of the financial firms from New York are moving to Florida and bringing their employees with them. It's not just Texas and Florida to focus on. There's lots of really good, strong growth markets, but just pay attention to where are the jobs going, where are the people going, and where is it affordable still for the people moving there. And I think this is important for people to hear, that in the greatest housing crash since the Great Recession, our properties in Texas fared well. The rents went up during that time because, of course, if people are losing their homes, they still want a place to live and they rent. It's kind of different today where people want a place to live, they can't afford it, so they rent. So we experienced it firsthand that in a horrible housing crash, those Texas properties did really well. They stayed rented because they were good quality properties, B class, even A-, and those tenants did not leave and they didn't miss a payment. In fact, rents continued to go up during that time. So not every market gets affected in recessions. Not every market gets affected in housing crashes. If you're in the areas, like I said, that have the job growth, population growth, and affordability. And there's a fourth pedestal on this chair that I came up with myself. The others were Robert Kiyosaki's. Mine is look for infrastructure growth. I want to be in areas that don't just cash flow, but that appreciate. I like both. I want both. So if you know that a city is investing in itself with infrastructure, building new roads, building schools, universities, hospitals, employers coming in, this is a sign that there's growth in that area. So when we invested in Dallas in 2005, trying to get out of the storm that we knew that was coming to the coasts, we looked for a part of Dallas where we saw freeways coming in and employers coming in. Not all of Dallas boomed, but certain parts of it did. And cities know where those areas are because they're doing the planning. They know where there's going to be new freeways. They know where the growth is going. So you can talk to the local chamber and find out where the growth is headed in that particular market. So then you get all four pedestals, and that makes for a solid investment. I'm Kathy Fettke. Thanks for joining me here on the Markets YouTube channel, presented by Fundrise. I'd love to hear your thoughts on where you think the market's heading and what you're doing to protect yourself. Leave your thoughts in the comments below. Thanks for listening.